The Fed raises rates by 0.25%, the 8th such move since late 2015, and the US dollar rises to 8-month highs versus the Japanese yen. There was never really any debate ahead of the key Federal Open Market Committee meeting this week. The Fed was going to deliver their third hike for 2018 at the September meeting, and they did, raising the Fed funds rate by 25 basis points to 2 to 2.25%, the highest policy rate since March 2008. The Fed also kept markets on guard for another increase in December too. The dot plots indicated that expectations amongst the committee have tightened for December, with 12 of 16 members now forecasting a fourth hike for the year. Now, in the recent past, the US dollar has actually weakened after the Fed raised rates. This likely has much to do with anticipation and positioning. The US dollar did weaken after the December 2017 and March 2018 hikes, though it started a steep rally after the June 2018 move, helped by a dovish European Central Bank meeting soon afterwards. This week's hike produced a fleeting fall in the greenback, seemingly in response to the removal of the long-standing description of the policy stance as accommodative. But over the following 24 hours, the US dollar traded up to 113.40 against the Japanese yen, a high back to December last year. In the quarterly summary of economic projections, the FOMC raised its median forecast for GDP growth over the year to December 2018 from 2.8 to 3.1. This may not be the much boasted about 4% pace, but it's a long way above the Fed's estimate of potential growth, which it kept at 1.8%. With the unemployment rate already in the mid-3% area and core inflation at 2%, little wonder the FOMC is projecting the Fed funds rate to rise above the long-term or neutral rate, and importantly, the median expectation for the committee for neutral was pushed slightly higher to 3% this week. In a world where most policy interest rates are either close to or at post-GFC lows, and those raising rates substantially are only in emerging markets anxious to shore up their currencies against the dollar, the medium-term US dollar outlook remains broadly positive. Westpac is forecasting further dollar strength through the end of the year, though there are forces that could slow such strength. The US midterms approach on the 6th of November, and the end of ECB QE is likely 13th December. Both carry regime-changing potential for markets. Markets are unlikely to fully embrace the Fed's so-called dot plot path for rates until deeper into next year either. Now, the combination of the stronger US dollar and concern about the potential impact of 10% tariffs on 200 billion of US imports from China, which took effect this week, saw the Australian dollar weaken through the end of the week towards 72 cents. This is despite ongoing strength in key commodities that Australia exports. Iron ore prices have been stable around $68. Coking coal prices strong at $200. Thermal coal is at 6-year highs at $115, and liquid natural gas prices at 3-year highs around $11. The strength in LNG prices is important to emphasize here. China's tariffs on US LNG may actually see switching to Australian supply, and especially so if China delivers on plans to boost infrastructure spending to help offset any US-driven damage to the export sector. This strength in commodity prices and volumes should be evident in the August trade balance, which will be released next Thursday. It's a busy week in Australia next week over and above this too, with the PMI on Monday, the RBA meets on Tuesday, building approvals are released Wednesday, and retail sales next Friday. In the US, Fed Chair Powell will speak on the outlook for employment and inflation at the National Association for Business Economists in Boston, which will be closely watched by the market. We also have the important monthly jobs update in non-farm payrolls data Friday next week. These are all factors we'll talk about in next week's Markets Update.